John's University. Today, I am proud to launch our Women Investors Club with 346 people on tonight. We are going to start it with Angela D'Angelo, 98 CBA, who will speak on Stocks 101. I would also like to recognize St. John's very own student organization, Women in Business, for their collaboration with this event. Some housekeeping rules before we begin. If you have a question, please submit it in the bottom right in the Q&A section to host, and Angela will answer them at the end of the presentation. Also, a recording of this webinar will be available to you on the Alumni Professional Development page on the university site. Now, I'm excited to introduce our speaker. Angela D'Angelo started her Wall Street career in 1975 after high school, when she obtained a trainee job as a back office P&S department clerk and key punch operator at Mayer and Schweitzer. She was attracted to the excitement of the trading room and asked if she could work in there. She was quickly told she didn't have the brains. Yet 46 years later, she is still on the desk. Angela was registered in 1979, working for Troster Singer Stephen Rothschild on the correspondent desk, then was offered an assistant trader position to her mentor, Gus DeVito. She worked with Gus for over 20 years, then became a senior position trader following his retirement. In 1986, Angela joined the largest wholesale trading house, Herzog, Hein, and Geduld, and returned to college in 1991. For the next 7 years, she worked full-time and attended St. John's part-time, graduating from the College of Business Administration in 1998. Angela has been at the benchmark company for the past 17 years, where she has been trading and talking to major institutional customers to open new accounts and facilitates meetings between the research analyst and various institutional customers. Welcome, Angela. I will hand the webinar controls over to you now.
Thank you. Thank you. You make me sound really important. I'm really impressed. It was a difficult job to get started on Wall Street. I didn't even know I wanted to be on Wall Street. I wanted to be an attorney. So you never know where fate's going to take you and where you end up. I'm here to talk to you about Stocks 101, try to answer your questions. I'm sure everybody is aware stocks are public ownership in a corporation. The more ownership you have, the more you can vote your shares. Voting is important, not so much for the little guys, but the big institutions definitely vote their shares and let their voices be heard. Be aware, when you own a common stock, you do not have any claims on that company. If the company should go Chapter 11 or worse, Chapter 7, you have no claim. You are not a holder. You get nothing. Your shares are worthless. The only people that have any claims on a corporation are the bondholders. Stocks are there is many different stocks. There's common stocks. Some of them pay a dividend, some don't. Usually the New York Stock Exchange stocks pay dividend, although now the NASDAQ stocks, a lot of them do pay dividends. Utilities pay dividends. Their dividends, of course, are not guaranteed. And sometimes you'll get a special dividend if a company has a blowout earnings quarter, which we're seeing now. We're in the middle of earnings seasons. Today was the most reported earnings of the season. You'll see some companies do a special dividend to shareholders. There's also preferred stocks. Some may be convertible to common. They usually have a fixed dividend. They always have a fixed dividend. Some may include voting, some not, different classes. And there's also different classes of common stock as well. Non-voting, voting, A and B. That's really the nuances. Most people just buy a common stock just to get their feet wet. Next slide. Where stocks are bought and sold. The oldest stock exchange in the world was founded in Amsterdam in 1602. The big guys, as we like to call them, they're traded on the New York Stock Exchange. Those used to be the more powerful stocks, the IBMs, the Home Depots, Caterpillar, those are traded on the New York Stock Exchange. Technology companies, biotech companies, those are usually traded on NASDAQ. Although right now it's become very blurred. The lines are blurred. It's not that cut and dry anymore. Microsoft, which is one of the big guys, Apple, Facebook, they're all traded on NASDAQ. The bulletin board is another place where stocks are bought and sold. A little bit to be wary about. Those are usually penny stocks, and you always have to be a little concerned when you look at a penny stock. Not saying they can't be legit. You just have to be very careful. If a stock is in Chapter 11, which they didn't file their filings, they didn't file filings, the SEC will put a Q on the end, delinquent in filings, and they'll get moved off NASDAQ and they'll get traded on the bulletin board. There are some good companies on the bulletin board. You just have to be careful. We used to call the bulletin board the Wild Wild West, but most stocks are traded on NASDAQ and on the New York. There used to be the American Stock Exchange, which got its name called the Curb, because if companies weren't big enough to be on the exchange, people would trade their shares outside on the curb on Wall Street. The New York Stock Exchange was actually founded in 1871 under the Buttonwood Agreement. And the reason it got that name is because shares were traded outside under a Buttonwood tree. A little bit of history. And then, of course, we now have the New York Stock Exchange on Broad Street. Next up, slide, please. I'm behind. Primary markets. Primary markets are stocks that are not public. So sometimes before a stock becomes public, it's called the primary market. That's where private placements are done. That's where roadshows are done. That's where investors meet companies. Companies go meet bankers, try to put an IPO in place, which is a public offering. Once a company becomes a public company, it is traded in the secondary market. That's NASDAQ and the New York Stock Exchange. Primary markets are when a company is introduced to the world, is introduced to the street, and it's between the owners of the company and the shareholders, the new investors. Secondary markets are where stocks are bought and sold and traded among shareholders. Next slide. Yeah, okay, we have there still is, there's a collection of indicators. So the Dow Jones 30, everybody is aware of the Dow Jones. You'll hear it on the news all the time. Oh, the Dow Jones did this, the Dow Jones did that. For example, the Dow Jones today, my thing went away. I don't know what the Dow Jones closed. How embarrassing. The S&P's, what happened to my indexes? The S&P's closed up too, kind of flat on the day. Boy, I'm embarrassed. NASDAQ closed up 31. So you hear these Dow Jones Industrial Average. What is the Dow Jones? The Dow Jones used to be the 30 largest industrial stocks on the New York Stock Exchange. They were only New York Stock Exchange stocks. Well, that's kind of changed too, because now you have Amgen, Cisco, Intel, and Microsoft as four of the companies on the Dow. So it's no longer just the largest Dow Jones New York Stock Exchange industrial stocks. S&P 500s are the largest S&Ps stocks. That's actually a better indicator of what the market is doing. The Dow Jones is 30 companies, weighted averages of 30 companies. The S&P is weighted averages of 500 companies. So if you really want to get a breadth of the market, we follow the S&P. I look at the Dow just to see what's going on, but it's really the S&P that's really followed. The old school of thought was the industrial stocks are traded on the big board, the New York Stock Exchange, and technologies, still most technology companies are traded on the NASDAQ market. Next slide. Ticker symbols is very interesting. There used to be a very good rule of thumb. If a stock had 4 or 5 symbols, it was on NASDAQ. 5 being a foreign symbol, it would have a Y at the end or an F. Anything that had 3 letters or less would be a New York Stock Exchange stock. Well, again, that's completely blurred. Facebook, which is a NASDAQ stock, the symbol is FB, and it has 2 symbols, and it's traded on NASDAQ. Green Dot, GTOD, is a listed stock, has 4 symbols, it's traded on the New York Stock Exchange. So Johnson & Johnson has 3 symbols. That would be the old rule of thumb, 3 symbols, New York. But that's been so blurred due to the fact that we now trade, we meaning over-the-counter NASDAQ traders, will now trade New York Stock Exchange listed stocks. That's within the last 20 years. Before that, you could not. It's very good to familiarize yourself with the symbols of stocks you like, so you know what you're looking for when you look them up, and try to figure out what the stock's doing for the day. Next slide. Investment goals. That's really important. Everyone has different time horizons, and everyone has different thresholds for risk. The one thing I would strongly stress to anybody that's investing, anyone that's starting their career, as soon as you get a job, put money into your 401k. Do not wait. Do not wait for time. Oh, I'll do that another year. I'm only 20. I just started. I can't afford it. Whatever. 10% of your salary if you can't max out your 401k. I've been in my 401k since I'm 20 years old. Thank God, because it's a great way to invest. I do keep a little bit of money aside now at this point in my life, where I decide, do I want to play? Do I want to own stocks and not have an account manager or a 401k administrator or a fund administrator holding, telling me what to buy or buying what I should be buying? You have to know your risk tolerance. You have to know what you're willing to risk. If you are not willing to risk, you really shouldn't be managing your own account. The one thing I always tell people is I buy what I know. Funny story about that is friends of mine went skiing. We went up to Canada to ski. I'm an avid skier. And there was a line outside this coffee shop. It was a brand new coffee shop called Starbucks. And there was a line outside. Who ever saw a line outside of a coffee shop, except when you worked in the city 100 years ago, when there'd be a line outside a chock full of nuts, and that was because people trying to get to work on time. But nobody would wait online for coffee. And this woman said, I'm going to buy Starbucks. Look at this line of people to get into this one Starbucks. And she bought it, and she made a lot of money buying that stock. I usually buy stocks I know. I always go back to consumer goods. That's usually where I feel the safest. People are always going to wash their clothes. People are always going to brush their teeth. And people are always going to buy coffee, apparently. Knowing your risk tolerance, that is very important. And you never, ever play with money you can't lose. That is very, very, very important. You look at the returns. Before you buy a stock, you kind of map it out for a while. You watch it, see what the trading range is, see if the earnings are due out, see what the 52-week low is, the 52-week high. You look at a chart. Are you buying it at its high? These are all things. Do your homework before you buy any stock. Do your homework. I can't express that enough. Next slide, please. Aha, do I trust trading sites like Robinhood? That's a good question. I really should not be. I can't comment on that due to my compliance. But I will say that when you buy a hype, If you have your own thoughts and you want to buy it on Robinhood, Amazon's a perfect example why you would buy that on Robinhood. Robinhood was the one that introduced fractional shares. I'm going off a little bit. I'm sorry, I'm answering a question. I don't know if I should be doing this, Stacy. You couldn't afford to buy Amazon. Amazon closed at $34.71, $3,471. And after the blowout earnings, it's trading at $3,576. So to buy one share of Amazon, you have to have $3,600. So Robinhood offered fractional shares. There is a place for that. If you wanted to buy Amazon, if that's where you want, you think this COVID virus has turned everybody onto Amazon, which is why it has blowout earnings this quarter. Robinhood's a good place to do it because they do offer fractional shares. If you're going to believe the hype of somebody on Robinhood, I would be very, very careful. And that's going to be a slide down the road when GameStop comes up. So Robinhood has a good place. It has a place, not for the hype. And now a lot of other companies are offering fractional shares. I believe Fidelity does. I think Schwab does. So they're not the only person that does that anymore. But that is why I would go to Robinhood or Fidelity or Schwab if they have fractional shares. And that would be my only reason not to believe the hype. I hope that answered your question. Next slide, please. Supply and demand. That's obviously how, anybody in school, anybody that's done economics 101, we all know how that works. The greater the demand, the less supplies, the higher the price goes. That's just the way it is. We all know what inflation is, right? Too much money chasing too few goods. Well, it's the same in stock market. A lot of money has been poured into the market with a lot of stimulus money. Again, I hope it's money you can afford to lose. And I always think that's not a good idea, but that's just my personal opinion. If it's extra money, fine. But supply and demand is definitely what drives the market. The higher the supply, the lower the price of the stock. The higher the demand, the higher the price of the stock. Earnings expectations. Now that's a great one. Microsoft had blowout earnings yesterday. Stock sold off. Why did it sell off after what it reported? It reported tremendous earnings, and I should just have my screens up so I know what I'm talking about. Excuse me while I look that up. Microsoft beat earnings by what did they beat by? And now I can't find it. How embarrassing. They did. They had record blowout earnings. Why did the stock sell off after the earnings report? The stock sold off after the earnings report because analysts didn't think it earned enough. So although you look at earnings and expectations, be careful. Just because the stock has blowout earnings doesn't necessarily mean it's going to go up. If the street sometimes will say, buy the rumor, sell the news. That's an old expression. So everybody gets hyped into the earnings thinking they're going to be blowout, and then you find out they were blowout, but they weren't blowout enough. I'm not an analyst, so I never understood that theory. I always thought that if they had blowout earnings, it would be good. And if you think so too, then you would look to buy it on a dip. So you have to do your homework. And you always have to look at economic indicators. Those are very important. The market took a huge dip today when the unemployment numbers came out today. Unemployment numbers for new claims was supposed to be 530,000. What came out? 553,000. I guess when 500,000 people are filing claims, 20,000 give or take is not a big deal, but the market didn't like it. And the market didn't like it because the revised prior numbers were higher, which meant more people filed for unemployment last month than they anticipated. The same thing with the weekly claims. Those got revised up. Again, more people are unemployed. There are 3 million people, 3.6 million people unemployed, currently unemployed due to the COVID virus. And what's the numbers? There's a whole bunch of people that's not included in the numbers. We all know that. People that either their unemployment has expired, they didn't file for unemployment, whatever reason. There's always more than this number. This number is just what the government reports. As well, look at the leading indicators. Pending home sales, we were expecting a 5% increase in pending home sales. They came in at 1.9%, an anemic number compared to what the analysts and the economists were looking for. Why? First of all, there's a housing supply shortage. We all know that. People put a house on the market, it's sold the next day. There's supply shortages. Lumber, you can't get the lumber to build the houses. Lumber is at an all-time high because of shortages. So that number was very anemic, causing the market to take a dip today around noon, and it sold off pretty sharply. S&Ps went from, the S&P minis went from 4209 down to 4168. So they took a 30-point hit on the S&Ps. Now, again, if you do your homework and you like your stocks and you see the S&P come in like that, it's a good time to buy on the dip because the market did recover today. You have to do your homework. That is, I can't stress that enough. Without giving any specific companies, where should you go to make a stock purchase? A broker. Again, I would buy what I know. You don't need to go to a broker to buy what you know. You don't need to pay a brokerage fee if you're going to buy Microsoft or Apple or Johnson & Johnson if you have a tolerance for the headline risks. There are going to be a couple of those as this thing unfolds, the COVID crisis unfolds. If you have an idea of what you want to buy and you chart it and you watch it, look at the highs, look at the lows, I would say open up a Charles Schwab account, open up a Fidelity account, a Robinhood account. But I think Robinhood has big fees. I don't have a Robinhood account, so look into that before you go there. And that's where you buy it. I would not go to a local bank. Definitely not. I worked for a bank at one point when my company was taken out by a bank a while ago, a long time ago, and they seem to push their products. So I would be leery of a bank. If you know what you want to buy it. You could buy it through any, Fidelity, Schwab. There's a million of the discount brokerages out there, and all of them charge zero commissions now. Be careful of the fees. Robinhood has big fees. I mean, they're making their money somewhere. They're not charging you zero commission and not making any money. So just, again, be aware of that. You always look at the economic indicators. You look at the unemployment numbers. You look at the consumer confidence level. How confident was the consumer? Interest rates. What did the Fed say yesterday on interest rates? The Fed was very dovish, meaning that interest rates are going to stay low for the next 2 or 3 years. So putting your money in a savings account is not going to pay you anything. You know that's not where to put the money, and that's why the market is one of the reasons why the market's at its all-time highs. There's nowhere else to make this kind of return except in the stock market. Again, buyer beware. I can't stress that enough. Next slide. Did I ever invest? Oh yeah, I've got some great doozies. I've got some winners, but I've got some doozies, let me tell you. But that's on, okay, knock on wood. The market does return more than a local savings bank or a larger bank. The reason is because interest rates are so low. And like I said, Chairman Powell said yesterday, he's very dovish. Interest rates are going to stay low for a very long time. I would not put money in a money market account. That seems to be another question. Money market account pays practically no interest. If you want to put money away and you want to get dividends, one of the safest places is utilities. Utilities pay a dividend. They're controlled by the government. They're controlled so that they make money. They're guaranteed to make money. REITs is another place where whatever they make gets sent back to the shareholder. I'm a little weary of REITs because right now I am a little afraid with the way COVID, some of the allowances that the government is giving with people not being able to pay their rent and being forgiven. The bank still wants their mortgage payment. So I'd be a little afraid with REITs, but REITs is certainly a place that has a guaranteed rate of return. And what you do with a REIT is you usually use a dividend reinvestment, which you could do with the Dow Jones Industrials. You have dividend reinvestments. Don't take that dividend money if you're young. Reinvest it. You don't need that $7.52 or $12.52 that they're going to pay you in a quarterly dividend. Reinvest it. Dividend reinvestment is a very smart way to grow equity. And you get fractional shares with that as well. So that's a way to do it. High yield savings accounts. I'm not a banker. I don't profess to be a banker. I'm not that versed in high yield savings accounts. I would look at how long you have to tie up your money. So if you're putting it in a CD, for example, and you have to tie it up for 3 to 4 years, you'll do better in the market. You'll be doing better buying a utility company than you would putting it in a high yield savings account. Again, I'm not a banker. You would talk to somebody who's more versed in banking. I'm sort of a stock person. I've really not put any money in high yield savings accounts. I can tell you I've never done that. I always stress your tolerance risk. You can lose money in the market. Nothing is guaranteed. So always think of your tolerance risk when you're putting money to work with you in the stock market. The stock market is right now the best place to earn any real growth. Just be careful what you buy. Try to buy something try to buy something that you think is going to be around a long time. Try not to buy a fad. Try not to listen to hype. How do I do my homework? That's a good question. Do your homework by looking. You can Google any company. Yahoo Finance is excellent. You can look at any company's annual report. You can look at any company's balance sheet. Does a company have a lot of debt? What's their debt ratio? Are they highly levered? What business are they in? Are they in an upcoming business? Are they in a lagging business? It's not as difficult to do your homework as you think. You just have to go to the mall. Are there people in forever? Well, now you can't go to the mall. Forget that one. But going to Starbucks was a very good example of that. I like Johnson & Johnson. Why? Because I don't think they're going out of business. And I think that, again, I'm not recommending Johnson & Johnson. I will stress that. I am not recommending any stocks. My compliance officer will have a nightmare if she even knows I named a stock. But anyone that does any biotech or any drug companies know that drug mishaps happen all the time. I mean, look what happened in Tylenol, right? Somebody laced the Tylenol bottle. Happens all the time. Because COVID is in the news so much, because it's such a hot topic, the stocks are going to have such swings. People are always going to buy baby products. That's how I do it. I like Coca-Cola. Why? I don't like Pepsi. Why? I like Coke over Pepsi. That's just a preference. If Coke had bad earnings, would I look at it to buy? Maybe. That's what I do. And it proved well for me. But again, I stress to do your homework. It's not that hard to do, especially now. You could Google any stock. You could look at anything. Yahoo Finance is excellent for that. Wait, you're going too fast. How do you do your homework? If you're not comfortable buying a stock, then go to a broker. If you're not comfortable, go to a broker. If you're starting your career, definitely go and put money in a 401k. If you're young, you put your money in a riskier 401k, a riskier portfolio, riskier mutual fund. Why? Because you have the time horizon on your side. If you're my age, you're not so much in risk anymore because you are looking to go into the next phase of your life and you're not going to be that risk. When I was younger, I had everything in higher risk portfolios, higher risk mutual funds because I had the staying power. If you're not comfortable, don't do it on your own. Do I again, I can't answer what utility companies, but if you Google any utilities, they will tell you the yield. They will tell you what the yield is. It'll tell you. You could do your homework on utility companies. Just Google them. Look at each individual one. See who's yielding what better return on your investment. Again, it depends on your risk tolerance. What's your opinion on a Roth IRA? Stacy, I think we went off program. Again, I don't trust the government. I know that a Roth IRA, you tax in and you don't tax coming out. The way the government is strapped for money, I'm just a little always nervous of that. So are they going to figure out a way to tax your earnings on a Roth? That's an answer no one seems to have an answer to. They say no. The government says no, you're taxed going in, you're taxed going in when you're at a higher tax bracket, presumably. And then when you retire, you're at a lower tax bracket, you're not taxed on that profit. I've never trusted the government. When I started investing, we didn't have Roth IRAs. And by time Roth IRAs came out, for me to transfer a portion of my holdings to Roth, I would have had too much of a tax implication. So I don't own any Roth IRAs. I do know that if you have both and you're, down the road, years from now, you have to take your traditional IRA first before your Roth because the government wants their money. So you don't get to take your Roth first and hold on to hold on to the stuff that you don't owe taxes on. The government wants their tax money first. I would do a little of both. Roth is certainly a good place. I just don't trust the government. I just think the way they're looking to tax everything, I don't know. They're going to figure out a way to tax that. That's just me. That's just a personal opinion. So, but again, talk to an investment advisor. They're the ones, they know all the nuances for that. They know all the instruments and how to protect your investment. That is not my forte. Next slide. What are my financial goals? You have to think about what your financial goals are. I always laugh and I say my financial goals is to sit on a beach or teach kids how to ski and not have to worry about money. When you're younger, you tend to become more, you should be more riskier with your investments. You should, if you're putting it in a 401k, you should look for a riskier 401k, higher risk, something that's more tied to the S&P, something that's, well, trying to think of a riskier investment that I would think where I would put my money. I think I put some stuff into some riskier biotechs when I was allocating some funds because I wanted some more risk. So when you're younger, you tend to be more risky because you have your time horizon. The older you are, you tend to be less risky because, let's face it, you're looking to sit on a beach and drink a pina colada. Never put your eggs all in one basket. Never put everything you own with one advisor, with one hedge fund. Always, always, always spread it. I don't even want you to put all your stuff in one bank account. You should always try to keep yourself diversified. Um, if you're looking for something safer, you know, the S&P. The S&P will give you a moderate return. It's the S&P 500, so it's the 500 S&P stocks. I think that's a safer way to play the entire broad market, to look at either any of the ETFs that cover the whole broad market. The S&P is the most popular. There's the IWM, the financials, there's a ton of them now. Again, there's lists of them all over on what ETFs cover what. And if you want to actively manage your own portfolio, again, I'm going to say buyer beware. Be very careful. I started managing my own portfolio after a while. I didn't think I was smart enough to do it in the beginning. Looking at my holdings today, I don't think I'm smart enough either. But again, my risk tolerance is there, and if I take a loss, I've put money aside. This is the money I can play with and have risk. If I made it, I made it. I'm really happy. Student loans. I feel for the people that have student loans. I have to tell you, the reason student loans are so out of control is because years ago when they started, when you first started and took a student loan, it was practically 0% interest. My brother took them out for all three of his children when they went to college. He took out student loans in their names. They established great credit ratings because they had this great, credit paying back the student loans. And my brother paid off their college tuition. My brother was fortunate. His children were fortunate. Somewhere along the line, some people decided not to pay back their student loans. And one story that I love to tell is that a friend of mine's daughter didn't pay her student loans back. She said, "Oh, I don't have to pay them." Well, when she started working, she got a lovely letter from the IRS that said, "Thank you. Your return has been applied to your student loan." So the fact that people stopped paying student loans is the reason they became such a risky instrument. They weren't meant to be that when they first started. I feel for people that have student loans. What I would do if I had a student loan now, I would see if you're working, if you establish a credit rating, see if you can roll that student loan over to another type of loan. If you own a condo, maybe you could somehow roll it with a home equity line of credit. Try to refinance your student loan anytime there's a decrease in interest rates. And I know they don't decrease the student loans because it's a locked audience, and they really are not nice, and they have you right where they want you. I would say try to pay off student loans as quickly as possible. If you have to pay an amount and you get an extra bonus from where you're working, pay it towards your principal. Try to reduce the debt on that student loan. And I know it's not easy. And I know you guys are looking at much higher loans than my brother did when he had children in school. What does it mean to roll over student loans? So there are other ways. You could take a personal loan. You could, if you own a condo that has equity, you may be able to take a home equity line of credit if that interest rate is lower than your student loan. Trying to think where, if you see interest rates come down, like Chairman Powell said, interest rates are going to be less for the next couple of years. Check around to see if there are cheaper rates out there, and if you could take out a new loan and pay off the student loan at a lower interest rate. Again, sometimes you can do that. Student loans are an animal all of themselves because they kind of have you where they want you, and bankers are not known to be nice. So that's what I mean when I say try to roll it over, try to find another loan out there that you could take, a personal loan, to pay off your student debt. Maybe you could find one with cheaper interest. And if you are working, any bonus you get, reduce your debt, principal only, send it to principal only and reduce that debt as quickly as possible. I hope that helped. That's what I mean when I say roll over your student loan, if you can. Stacy, can we go to the next slide? Every stock has a ticker. Microsoft, MSFT, Facebook, FB. When you read a stock table, you look for the name of the stock, you look for the symbol, you find out where the stock is currently trading, the last sale, the opening, the close, how much the net changes, what did the stock do on the day, the percentage of change. You look at the 52-week high and low. Are you buying a stock at the high? Why? Why would you buy a stock at the high? There's something called a chartist. Chartists will look at a chart and they'll use the expression, if you've heard it, if you listen to CNBC or any of the financial networks, Fox Business News, you'll hear people say a stock is, the chart is going to have, it's going to blow out, like it's a blowout chart. It's a hockey stick. It's a breakout. Breakout is what I was thinking, Apple, breakout. So when you hear people talk about a breakout, then you buy a stock at the high because you know it's going to go high. You hope it's going to go higher, right? Nobody knows anything for sure. If there's nothing new coming out on a stock, if the market is just hot, maybe you want to wait for the stock to pull back. What's the volume? Volume is a great indicator. Is the volume surging? Did it close with more volume than it did yesterday? Did the volume increase week over week? Is there momentum buying in a stock? That'll cause a stock to have a breakout, and you may want to buy a stock at a high. Again, you have to do your homework. You have to do a little bit of research. You want to look at a capitalization of a stock. Are you buying a high price, a mid cap, a low cap? A large cap is 10 billion or more. Low cap, there's also micro caps. Small caps are anything from 300 million to 2 billion. Anything less than 300 million is called a micro cap. Mid caps are 2 billion to 10 billion. So you kind of want to know the range that you're trading in. What's the other peers doing? So if you like Lowe's, for example, you go to Lowe's and there's so many people in Lowe's, you're like, I like this stock. What's it doing in comparison to Home Depot? If you like Costco, wow, I go to Costco, there's so many people. What's it doing in comparison to BJ's? Do your homework. You like UPS, maybe UPS reported great earnings. Wow, FedEx is going to report a week from now. Maybe you start looking at FedEx. These are little tricks, if for lack of a better word, that all of us look at. Well, UPS had great earnings. I'm going to look at FedEx. FedEx had great earnings. I'm going to look at UPS. That's the way you compare oranges to oranges. Costco, every time I go to Costco, the line's out the door. What's BJ doing? When does Costco report? When does BJ report? So you try to familiarize yourself with the earnings cycle. We are in earnings cycle right now. Today was the largest earnings day with the most companies reporting. Price and earnings ratios are very important. What's the stock doing? What's it doing for the last couple of quarters? What were the PE ratios? What did it earn against the stock? How many times over earnings is the stock trading? Did the stock earn X and yet it's trading at 20 times earnings? Is that excessive? Look at the group. Look at other names in that group. What are they trading at? Are they trading at 10 times earnings? Why is this one trading at 20 times earnings? Very important to look at the ratios. What can you recommend? Oh, there's lots of books. I mean, I have a book, 101 Technical Analysis for Dummies. I read, that's where when I look at a chart and I listen to people on CNBC and they talk about all these different things, I'm like, I'm not a chartist. I don't really understand it all. I mean, I know how to read a basic chart. So I bought that book, 101, chart techniques for dummies. And I looked at that and kind of familiarized myself with various chart expressions and what people look for on charts. They have those 101 books for dummies. They have them all the time. I mean, you could look at them. They're the basics, but that'll put you on the right path. That'll get you to where you need to be so you can feel confident. Talk to people. Talk to an advisor. A lot of advisors will have a conversation with you and really not even charge you, just to pick your brain, just to pick so you can pick their brain. There's tons of seminars that have them. Listen to the people on CNBC. Listen to the people on Fox Business, Bloomberg TV. These are much smarter chartists than I could ever be, much smarter analysts than I could ever be. They'll tell you why. There was a gentleman the other day, I'll leave his name off because my compliance officer would kill me. He was looking at pool companies. Why? Because everybody stayed home last summer. You can't put a pool in. You can't put a pool in because people had to stay home. People that owned houses bought pools to stay in their backyards. All right, well, maybe look at pool supply companies because that's, people are always going to have to service that pool. I'm not saying it's not difficult, but if you just listen to the analysts on the television, they can steer you in a direction that may pique your interest. If you buy stocks in an IRA account, then the tax implications are held off until you retire. If you buy stocks in an IRA, you don't pay any capital gains tax until you sell that stock, until you retire and you pull your money out of your IRA. If you buy stocks with cash, you do have capital gains. Depending on your tax bracket, depending what Congress does, I'm not going to talk politics, but they're talking about raising capital gains. I don't really agree with that. That's my personal opinion. Capital gains are where people create wealth. That's how people get wealthy, is by capital gains. It could put you into another tax bracket. Talk to a tax guy. If you're investing small, don't worry about your tax bracket. I mean, if you buy something at one, it goes to $1 million, God bless you. Yes, you'll have a tax implication. But that just goes with the ability to buy and sell stocks. You can write your losses off. Hopefully there'll be none. There always are. You can write your losses off your gains. So if you lose money on something, but you made something in something else, you're allowed to write that loss off against your gains. If you sell a stock under a year, do you pay your capital? Do you pay more taxes? Yes, the capital threshold. Okay, now you're going to make me do homework, guys. There's a threshold for capital gains. What is the time horizon? I think it's less than a year. It's treated as ordinary income. What is time for capital gains? I think it's less than a year. I think if it's less than a year, then you pay ordinary income. If it's more than a year, I think it's capital gains. I just Googled it on Investopedia. That's a great website. I use that a lot myself. Usually gives you the long and shorts and explains things really well, basic things. But yes, there is a difference between ordinary income and capital gains, and I believe it's a year. I got to get through this. I only have a little bit time left. Next slide. Let's see if I can get through this. Okay, there's a chart. That's a time horizon. That's a snapshot that only gives you a 6-month reading. It tells you what the stock's done for the 6 months. So you look at it and you kind of chart. So this, the lower the stock was 200, higher the stock was around 250. That's a good snapshot of your peaks and valleys. If you want to buy it on a peak, on a valley rather, you watch a stock through a chart, and that's what helps you have your investment, where to pick your spots. Next slide. I'm trying. Next slide. Bonds will pay a dividend. They pay a coupon. Bonds do have equity holdings. If a company goes belly up, you have a stake in a company. Bondholders get paid before anybody else. Stockholders do not get paid. I do not recommend buying on margin. You have to be careful what margin requirements are. There's a fee. So if you want to short a stock or buy a stock on margin, and it's a hot stock and it's hard to borrow, that fee is going to cost you, and you have to include that cost in your analysis of what you paid for the stock, and that's how you get your true cost. Buying on margin is always scary because the day the stock market goes down and you get 1,000-point drop, which is really only, don't forget, the market's at 3,400. 1% is $3,000, is a 3,000-point drop. You're going to get a margin call. If you don't have the money to put up, you have to sell stocks to cover that margin call. Dollar cost averaging, my favorite. Old expression, don't throw good money after bad money. Sometimes it works. I've been lucky. But if something is a dog and you don't have the time horizon to hold it, better to set your goals. If it gets to this level, I'm going to sell it and walk away. I don't really live by that because I can't practice what I preach. Throwing good money after bad money sometimes pays off. There are times where it doesn't. If a stock's going down and you could throw money at it, it's not going to help. So again, is it a good company? Why did the stock sell off? If you want to throw good money after bad money, do your homework and say, well, I think the product has some value. Selling short is something very dangerous. You're selling something you don't have. Being a woman, it's like selling a pair of shoes you don't own in your closet. You have 3 days to make that delivery. If the shoes don't come cheaper, you have to go into the marketplace and buy those shoes to satisfy. There's a fee involved with borrowing stocks. When you own something, you own it at $10. It goes to zero. You lost $10. That's just arithmetic. You short something at 10. The upside is forever. Look at GameStop. Somebody short at GameStop, stock ran to 400. If you shorted GameStop at 100, that stock went to 400. Did you have that risk, that tolerance, that fortitude to roll that short over until it broke? Takes a lot of money to do that and a lot of fortitude. GameStop, everybody, what's the hype with GameStop? They're trying to see, the hype on GameStop is, could the guy from Chewy, could this ex-CFO of Chewy, can he do for GameStop what he did for Chewy? The Reddit, Roaring Tiger was his handle on Reddit. He says there's a value. I'm not disputing him. I'm not going to badmouth him. Every analyst you speak to tells you that GameStop, there is no value because GameStop it sells hard video games, actual games. Everything's digital. Everything's digital. Our own analyst had, well, I can't tell you what he had. If you look at all the analysts on the street, they all have sales on GameStop and they all have a $30 price target. Why? No one's buying physical games. The guy from Reddit, Roaring Tiger, Little Kitty, whatever his name was, he did his homework and he said there's a value. I'm not disputing him. God bless him. He did his homework. Could the guy from Chewy, can the ex-CFO from Chewy, can he in fact turn GameStop around? What's his plan for GameStop? That's, shorting a stock, you have no limit on your risk. Buying a stock, your limit is your purchase price, cut and dry. So I wish the CFO from GameStop a lot of kudos. I hope he can turn the company around. They did a secondary. All those people that bought the stock, they did a $500 million secondary. Again, I don't know. Much smarter people than I have said that the company doesn't have anything because nobody's buying physical games. The guy from Reddit, Roaring Kitty, said he did his homework. There is a value. The ex-CEO of CFO of Chewy, they turned Chewy around. Could he turn this company around? Time will see. He's very intelligent, and look what he did with Chewy. So time will tell on GameStop on who's right or wrong. I wish, and the gentleman's name is Ryan Cohen. I was remiss in not giving him his just reward. His name is Ryan Cohen. He did a great job on Chewy. Can he do it with GameStop? I don't know. I would be staying away. I don't know. I don't know what their business model is. Much smarter analysts than I say, and I'm not an analyst, but much smarter people on CNBC say they don't get it. GameStop was conversation for, I think, a month straight when it ran to 400. Now, the guy that bought it at 400, he wasn't so lucky, was he? Again, be careful of the hype. Do your homework. I'm not disputing the Roaring Tiger. Is that his name, Roaring Tiger? I'm not disputing his homework. He said he did his homework. He said the company has value that Roaring Kitty. He's saying that there's value, unlocked value there. Okay, he did his homework. I don't know. Next slide. Difference between options and futures. They both have an expiration date. Futures are usually done with precious metals, oil, gold. Those are usually traded in the futures market. Option is the vehicle of which you buy and sell stocks at a certain strike price for a certain amount of time. Options have expiration dates, so do futures. Be careful with options. People will buy and sell options in and of themselves because they can't afford the stock. So they'll buy a Facebook option, an Amazon option. Be aware that when you buy an option, it has an expiration and a strike price. It says you're going to either buy or sell a company at a certain price by a certain day. If you do not exercise that option or sell that option, it expires worthless. So I leave the option trading to people smarter than I. I'm not cutting myself short. I just think that there's a whole strategy. Do you buy calls? When you buy a call, it means you're calling a stock. So if you like Facebook and you think the stock is trading, if you think the stock's going to trade higher, you'll buy a call. That means you're going to call the stock at a certain price. You're going to exercise that option. And then when the stock goes higher, you're going to call that stock, own the stock, and sell the stock. A put option means you're going to put, usually a bear person, bull and bear, is a put option. Means you think the stock's going to go lower. So what you do is if you think Facebook's too high, you may sell a put, meaning that you can put the stock to somebody at a certain price. Again, Options 101 for Dummies. There are all those books out there. You have to know what you're doing. Just be prepared. Be aware that an option does expire worthless if you don't exercise it or sell it. The same with the futures. They're predetermined price. Next slide, because Stacey's going to yell at me. Bull and a bear. Bull person wants the market to go up, a bear wants the market to go down. An old expression, bulls and bears make money, pigs don't. What I do in investing is if I like something, I buy something, I'll put a price on it. If I buy something at 5 and it goes to 10, I sell it. That's what I do. I don't look at it again. If it goes to 15, that's for the next person to make their money. Another strategy is if you buy it at 10, you buy it at 5, it goes to 10 or 7, sell half of it. Get back your investment. Now you're playing with free money. If it goes to 20, God bless you, in the money. You got your investment back and you're playing with money that didn't cost you anything. That's a way to do it that protects your investment. If you buy something and it goes down and you don't have that tolerance for throwing good money after bad, sell it, walk away, live to play another day. That is old rules that much more people that have much more money than I have lived with and have lived by. Bulls and bears make money, pigs don't. That's an old Wall Street expression. Can you please repeat that 7 rule? I don't know what the 7 rule is. What 7 rule? I don't know. I'm not sure I understand the question. 7-3. Was that a slide? Hold on. Oh, the investment goals. Got it. So what I try to do is, if you're starting your career, put your money in a 401k. Put your money away. Let somebody manage your money. Oh, no, I was giving ratios. Okay, I'll go to that one. PE ratios. You want to know what a stock is trading at. The stock is trading at 25 times, 30 times its earnings. You always look at the ratio of a company. Companies give, they trade at expected earnings. So what they made this year, what they're going to make next year, what they're going to make next quarter. So there is a ratio where a company trades, where the price of the stock is in relation to what the company earned. You want to look at that. You want to see what the PE ratios are. You want to see what they are in the group. So if a stock is trading at a lower ratio than its peers, peers meaning anybody in that group of stocks, why? Why? Is it a hidden gem that you found that maybe nobody else has found yet? Or is it going out of business and everybody is staying away from it? So you look at ratios to what a company is doing, and you look at it in relations to the other stocks in that group. You can always compare everybody's earnings. You compare it to where they trade. Is it a laggard to its peers? Is it priced higher than its peers? Does it deserve its valuation? And why does it deserve its valuation higher than its peers? You could look at all kinds of annual reports to see what the company does. I think you could ask Stacy for a copy of the slides. And if you have any questions, please ask Stacy and she'll reach out to me and I'll see what I can do to help. I've been doing this a long time. I think the stock market is the best place to get a return on your money, only because there are no interest rates. But I always preference that with buyer beware. You have to know what you're buying and don't buy and stay away from hypes. I can't stress that enough, unless you have money to lose. If you have money to lose and you want to throw something, hey, somebody told me about this great tip, and okay, because if it goes to zero, it's like going to Atlantic City or Vegas. If it went to zero, you didn't lose anything. You knew you were going to lose that money. I think that's all the time we have, Stace, right? 7 o'clock?
You know what? We're over a little bit, but I do have 2 questions that I think it would be nice if you can answer quickly.
Okay.
The first one is, I do know to have at least 9 months of emergency savings. But with that said, what percentage do you put into stock versus savings? percentage of income?
Okay, am I on LinkedIn? Yes. um, I'm old school. I'm a little older than you. So I come from the theory is you put 10% of your money into a savings account. You need money for a rainy day. You lose your job. You broke a tooth. I don't know, your shoe broke. You need something to fall back on. I know that's not the millennial way. I know I'm old fashioned, but you need something. God forbid there's an emergency. You get a flat tire. You can't do everything on credit. You got to have a little cash somewhere. God forbid a rainy day. So I'm old school. I would always put. I would look at my bills. I would look at my rent. I would look at my mortgage, and some percentage into a 401k, whether that be 10%, whether you could max out the 401k for the year. I'm not sure. It might be 16,000. Mine's a little higher because I'm older. I try to max out my 401k. But that being said, if you cannot put some percentage in a 401k, put some percentage for a rainy day in a savings. I don't care if you put it in the mattress. Put it somewhere that if you need to get something, you have it. Sometimes not everything can be done on a credit card, or maybe you maxed out on your credit card. You need to have some money put aside for a rainy day, but I'm old school.
Last question. How do you know when to take money out of the stock market when it's doing well?
Again, I use my don't be a pig analogy. You bought something at 10, at 5. It goes to 10. You want to sell it. Sell half at 10. Sell half at 10. I can't talk right now. I'll call you right back. Sell half at 10. Then ride the rest with their money. So if it costs you $1,000 and the stock goes to $2,000, you get back your $1,000 investment. Now you own that stock free and clear. I like that. That to me is I could play. It goes up, it goes down, and I play around that. If it goes higher, maybe I sell a little bit more. If it goes down, I can buy some because I have my $1,000 investment, right? I didn't lose that, so it gives me a little bit of playing power. I try to always put, and then there's some things you put away forever. Some people do that with Apple. Again, I'm not recommending any stocks, but you listen to CNBC, they'll say, buy Disney and walk away, buy Apple and walk away. I don't know. I have a couple of those, and you do that because you're thinking in the long term it's going to be something great. But in the short term, if I'm going to buy and sell, what I do is I try to get back my investment, and then I work with free money, their money, my gains, and play with it there. So I try to protect my investment.
Thank you. I think we need to wrap up. Do you have any last thoughts that you want to share?
The only thought I would have is I can't stress enough to do some homework. Try not to buy on hype. Try not to believe everything you hear online. I'm not saying that a stock can't go up. I mean, somebody that bought GameStop at 100, it went to 400. That guy did well, right? So there's definitely, for every one of those, there's the guy that bought it at 400 that went to 100. There's many more of those, more than the other way. So I always say, try to know what you're buying. Try to do your homework on what you're buying. If you can't do it, if you don't know, go to an investment advisor. I would stay away from an investment advisor in a bank. Personally, everybody's got their tolerance. Everybody does what they think is right. Maybe if you have a family friend that worked at a bank, that would be different. But I tend to think that banks sell what they're pushing. You can always find investment advisors. They always have seminars. Listen to CNBC, listen to Fox Business, listen to Bloomberg. There's many places to find people that will love to help you invest. Not me. That's not my forte. I try to buy buys and sellers and match them. I'm a trader. I'm an old-fashioned position trader. That doesn't really exist anymore. Stace?
Thank you, Angela. Well, with that said, I would like to thank everyone for joining us today, and a very special thank you to Angela for such an informative presentation. We did have 374 people on today. For more information on the Women Investors Club, please go to stjohns.edu/APD series. We will continue our quarterly meetings on July 1st, where we will discuss what you should have in your portfolio. I look forward to
I
continue.
want to be on that. I want to listen to that.
I'll make sure you get the invitation.
Yeah, that's very interesting. I want to listen to that.
I look forward to continued success of this club and absolutely future collaboration with our student organization, Women in Business. In the meantime, have a great evening, everyone.
Thank you. And thank you for inviting me. This was a pleasure. I love being a St. John's alum. I can't thank you enough, Stacy, for reaching out.
You're so welcome. Thank you for being here.
Thank you.